Good morning, everyone. Welcome to this global rundown for stocks and commodities for the 28th of April. The US market managed to just inch to a new all-time high, but it's pretty marginal on Friday night. And the bullish rally, particularly in the States, continues. And Australia did pretty well, also closing around the 6,400 mark as some strength came back into the banks. Got a lot to cover today. Obviously, we've had a couple of broken weeks with Easter and then Anzac Day, so a little bit of ground to catch up on. Now, I've got a really important message, I think, today, and that is to stay bullish, but we're at a time of the year now where if we are going to get a correction, and I'm not saying that we will, but if a correction is going to come along, then this is the time of the year, May, June, July, etc., when it's more likely to occur than not. So I think tactics are critical at this point. So I want to talk around that, and also I guess my main message is be prepared to change quickly if the evidence supports it, because I think we're in the late stages of the business and economic cycle, and things can change quite quickly. And what tends to happen towards the end of a cycle is that people start to get more and more bullish and more relaxed about what's going on. The better the news gets, and that's probably the worst time to get into that state of mind. So it's really very much about being aware of the surroundings in the market. Anyway, more on that when we get to it. There'll be the normal stock and commodity trend updates, and in Portfolio Analyst last week, I did actually spend quite a bit of time looking at the reasons why the rally can continue. And a lot of people, particularly when bull markets have been running for a long time, they want to focus on why the bull market should stop. And very few people look at the reasons why it could continue, and there's actually still quite a compelling case for that to occur. There was also quite a few questions from different members on medicinal cannabis stocks, so I don't know why that suddenly hit the headlines, but might have been just coincidence. But I had a number of questions around that, and there was also a lot of analysis done on various Australian stocks. There were one or two that I liked. Some of them I was fairly neutral on, and a few of them I didn't like at all. So as always in Portfolio Analyst, I call it very much as I see it. I think people want an independent view, and that's what I'm going to continue to give them. Now, the big global picture, and I want to be really clear here, because sometimes my message can be a bit misconstrued if if people are really just sort of looking at the headline. I remain bullish on the market for very sound fundamental reasons. So that would be the first thing. The fundamentals, particularly in the US, are still quite sound, not so much in Australia. Secondly, because the trend is still intact in the States. The market is still going up, just set new all-time highs, and that's just the way that it is at the moment. So you should go with that trend. And thirdly, because of the reality of the market, and that is that there's still quite a lot of cash on the sidelines, and it's just a sheer weight of money that's chasing a return on a limited supply of assets. And that's causing some assets to rise very quickly in price. And I think this is only going to continue to build more and more, and particularly in the Australian market. If you look at how much is in the superannuation pool at the moment in the Australian market, and how much is going to be in that pool in 5 or 10 years' time, then you've got a relatively limited number of assets that money is chasing. And so it just tends to keep an upward pressure on asset prices. But look, having said that, I'm wary of a couple of things. Firstly, at a big picture level, if inflation, and I say if because inflation hasn't raised its head People have been predicting it since 2013, and it hasn't raised its head yet. So that still remains a big if. But if inflation were to return, then all bets are off in terms of my bullishness on the bigger picture. And conditions would change very quickly. The Fed would have to start tightening, and we saw what happened last time in the last quarter of last year when the Fed started tightening. So don't get complacent on the bigger picture. Now, the second thing that I'm wary about is the market has just gone up in such an amazing V-shaped recovery that a short-term retracement is just, well and truly overdue now. So, I'm just sort of wary of those two things, but I remain bullish. But as a result of that, and personally, I've done very little in the US in recent months because, my firm view is if you want to get an edge on the market and you want to be able to limit the short-term risk, then you really need to be waiting for a dip, and that's what I've been doing. There's been a few stock-specific situations that I've taken advantage of in the States and a few in Australia, but I've really not been doing a great deal. In Australia, my focus has been largely outside the top 100, as members would know. And stocks like Webjet, and this is not a recommendation to buy Webjet because it's just gone up, very nicely in the last few months. But stocks like Webjet have been offering really strong returns, and with limited downside when we started to accumulate them. And in my opinion, Webjet is still very cheap because the earnings visibility going forward for the next couple of years is very high, and it's very strong. And we're up 25% on a stock like Webjet. So that's been a good one, and it's been a real highlight. Now, these opportunities in medium cap stocks of some substance are rare. They're hard to find, but they are out there. And generally they come about because there is a perception in the marketplace that the stock is not going well. And that was the case with Webjet. It came back from $18 back to about $11, and that was very much on the market misconception about how well their business was going in Europe. And as it turned out, the business was going just fine, and now the share price is back at $17. So those opportunities are out there, but you've got to be able to spot them, and you've got to be able to, take a deep breath and buy into them when the rest of the market is pretty negative. So overall, my key message is to stay bullish, but there are times to be aggressive, and that was January, February, and there are times to be cautious. So timing is critical. So just to run through, I've already covered some of this, but let's just run through this slide. So the rally, I believe, is set to continue. All the elements are in place for that to happen, but there are some concerns. And to get a little more specific, what bothers me a bit at the moment, particularly in the States, is that there are so many IPOs for companies that are unprofitable and look to be unprofitable for many, many years to come. Some of the IPOs like Lyft and Uber and some of these stocks, this often happens near a major top in the market, so that bothers me a little bit. There are also too many tech stocks that are being given absolute blue sky multiples, PEs, well in excess of 100 or 200 times. Now, if a stock has what I call an X factor, which is, it's got some sort of ability to change the way the business is done, or it's got a niche in the marketplace that is unique, and I'm talking about stocks like Amazon, Google, they certainly changed the way business was done. Stocks like Afterpay Touch have got that X factor. In those cases, the blue sky multiples are possibly appropriate. And if you think back to what people were saying about Amazon 10 years ago and where it's come to now, then the valuations, or what the seemingly extreme valuations around Amazon 10 years ago, have now been proven to be well-founded. And so there are some stocks where that blue sky multiple is reasonable. But I'm seeing many tech stocks that don't have that X factor that are being priced now at extreme multiples. So certainly some care needs to be taken there. There are also too many businesses that have got, little resilience to competition, and they're being priced on stupid ratios, and only a small fraction of those companies are going to survive. So that sort of makes me a little bit wary as well, but that's not a reason to get out of the market. That's just a really good reason to avoid those sort of stocks. So stock selection is critical. Now, what could change? Well, as I said before, the Fed capitulated at the end of December when they saw how badly the market reacted to them tightening, and so they backed off. But if inflation does pick up, then the Fed will perhaps have no choice, and they will have to start tightening, and that'll kill the bull market. And I think it would be a major move. So inflation is something that I'm watching extremely carefully. But look, it's been talked about for 5 years, hasn't materialised, so I wouldn't be taking any action on that basis. Just be aware of it. Don't get complacent. That's my message. A couple of other things that bother me, and I've spoken about this before, and also in Portfolio Analyst, is the dynamics around index tracking funds really bothers me, and I think that's part of the reason that the US market in particular just keeps going up and up and up. It's been a self-propelling mechanism on the way up over many, many years because the index funds have to buy because the market has gone up, which causes the market to go up, which means people have to buy. So it's a self-propelling spiral in the upwards direction. What happens if we eventually reach a point where they have to unwind because of forced redemptions? Then what has taken many, many years to spiral upwards can perhaps have to unwind in a much, much shorter period of time. And so an ocean of money has got to drain out through a garden hose in a panic environment. And that bothers me. But again, it's like inflation. People have been talking about this for a long period of time, and it has not eventuated. And the conditions, as I'll get to shortly, the conditions in America for this bull market to continue are actually quite strong. There's a lot of reasons why the bull market can continue, but I'm just observing that there are factors at play that could change the situation quickly. So that's all I'm saying. Just don't get complacent. Be alert to the fact that things could change quite quickly. All right, so the odds favour this rally continuing well into 2020. That should read or beyond. So that's my base case. But just don't expect it to that will occur. Now, looking at US stocks, the S&P had a pretty good week, gained 35 points. We just made it to a new all-time high. Technology is clearly the outperforming sector, and also consumer discretionary is doing really well. They've had an enormous run, so you just got to be really, really careful about buying into those sectors at the moment. And as I said at the start, I just really haven't done a great deal in the States in the last couple of months. I'm just waiting for that bit of a pullback, which is inevitable. Now, earnings season is progressing quite well. The results are ahead of expectations, even though they're lower than last year. But last year had those one-off tax cuts. But look, earnings season beating expectations, and that's what's important. I was really surprised to read through the week that there's an expectation now that the US Treasury is actually going to be in surplus in April. Now, everyone's talking about, the massive debt in America. But if you remember when Trump first got in, and this isn't an advertisement for Trump because I think he's a bit of a dingbat in many ways. However, it's pretty hard to deny what he is achieving at the economic level. When he came in, you may recall that he said, we're going to cut taxes, we're going to stimulate business. And everyone said, yeah, but what about the debt? And he said, well, the debt will get offset by higher Treasury receipts. And I don't think anyone really believed him, but perhaps we are now just seeing that formula is producing what he said it would. And if there is an acceleration in Treasury receipts, if this is more than just a one-off, then America is set on a very solid foundation for economic growth for quite some years to come. So that might just be the first of one little green shoot. So I'll keep an eye on that. More on that in coming months. The other reason that I still remain overall bullish in the longer term is that bullish market sentiment is still well in check. In fact, bullish sentiment actually dropped last week in America. Less people were bullish than the week before, even though we set new highs. And you don't get that at major market tops. It's the other way around. Everyone's getting really quite bullish. And the other factor is that there's been no PE expansion yet. So that means that stocks are still trading at roughly the same PE level as they were 6 months ago, 12 months ago, 2 years ago. So that means that the market is not getting any more expensive. It's only going up in step with earnings and therefore is sustainable. So these are all the reasons that that the market can continue to rise. Now, the US dollar sharply higher last week in response to that economic data. The US 10-year Treasury, however, was down slightly, down at 2.5. And amazingly, everyone's been talking about the 2-year, 10-year yield spread and dropping into recession, and that was going to be the end of the bull market. Well, guess what? The spread is now widening. We're moving further away from recession. It didn't happen. It was just another whole set of things for people to worry about that never actually materialized. So my message is, watch the price action, not the headlines. This is a monthly chart of the S&P. So we're way back here at 2000, right over on the left-hand side. So this is very big picture, and you can see this amazing run that we've had from the lows in the GFC. Looking at it on a daily basis, you can see we just edged to a new all-time closing high, but it's quite normal to see markets just overshoot a little bit, create a bit of a false breakout, suck a lot of unwary people in, thinking the rally is taking a new leg up, and then it comes back again. So, and we are quite overbought. So just be cautious at this time of the year. I wouldn't buy anything at all unless it's gone through a very recent dip. I think that's really the only way that you should be buying. And we're actually seeing a few of those opportunities. The healthcare sector pulled back over the last 2 weeks, created a really nice dip and some opportunities in that area. So that's the US market. There's the US dollar index. So we've been in a consolidation for a period, and now we're just starting to move out of that consolidation now. So perhaps heading back towards 100 on the dollar index and above. Turning to the Australian market, our dollar that should read slightly lower, down to 70.4. It did actually go higher since the last video that I did, but we actually ended up reasonably weak. And that was really because the chatter has really started up again now, big time, about the RBA needing to cut rates, and that's really keeping the pressure on the Australian dollar. And if they do, which looks more likely than not, then you can probably expect the Aussie dollar to perhaps fall below 70 cents. Our index, however, with a strong lead from the banks, I don't understand why, but there was a strong lead from the banks, up 125 points on the week. I'm avoiding most of the top 100 because they're tied to the health of the Australian economy, and I'm very concerned about the health of the Australian economy and very concerned about the political system in Australia, which I don't think has the capacity to get us back on the right footing. And that's, any side of politics. I'm not being partisan here in any respect. I just think we have a terrible crew at the moment in Canberra, and I don't think they have the capacity to change the direction of the Australian economy, which is not good. Let me just take a look at the ASX 200. Okay, so you can see we're just setting some new really long-term highs. They're not all-time highs, but we did set some highs in August of last year before we entered the correction, and we just managed to close just a whisker above that in the last few days. But we are quite extended and overbought. If there's a bit of a pullback in the US market, then our market will pull back as well, quite obviously. Precious metals, gold up to 1287, and that corresponds to an Australian dollar gold price of 1828, and I think anything over 1800 is pretty bullish for our gold miners, because most of them have costs of production, all-in sustaining costs, of around somewhere between $1,000 and $1,200 an ounce, and that gives them a 50 to 70% profit margin, and that's all in sustaining costs. So that's a pretty true margin. There seems to be buyers willing to provide support at 1270. That seems to be a fairly key level. The buyers stepped up very willingly at that level. GDX was flat on the week. It's not really responding at the moment, but as we move through this cycle, the case for gold and gold stocks, I think, will continue to evolve. I don't know whether it'll continue to evolve at snail's pace, which is what it's doing at the moment, or whether that will accelerate as it did in the first half of 2016. I guess you would need some fear to return to the market, or you would see some inflation needing to return to the market as well. So a major acquisition cycle is now underway in the States, which is important. So we'll just look at the gold price, and you can see from the weekly gold price that we didn't get a lot of change. Other commodities, copper was down slightly to $2.90. It's really just moving with the currency. Crude oil spiked higher, but ended up closing down. There was actually quite a strong spike above $66, and then it collapsed very much on Friday. And that, from what I can ascertain, is really just some rhetoric around Trump trying to put pressure on OPEC and saying the price was too high. I'm not quite sure that's how it works, to be honest. There's the copper price. We haven't done anything really for pretty much all year. Copper inventories have moved up to a degree, but if we look at it over the last 5 years, you can see we're still closer to the lows than we are to the highs. So that's all fairly supportive of the copper price. There's the spike and then the collapse again in crude. Trump trying to engineer things. So just to wrap it all up, what do you do in this sort of environment? Well, you avoid the rubbish and the hype stocks. I think that we're now at the stage of the economic and business cycle and the stock market cycle that those sort of stocks are going to get absolutely hammered mercilessly in a pullback in the market. So you really want to get out of those sort of stocks. If you do own high multiple stocks, then ensure that it has that X factor. A stock like Afterpay Touch, I think, is okay to own some of that. But there's a lot of stocks that are trading on very high multiples that don't have that X factor, and they're going to be hurt very badly. Only accumulate on dips. Take profits regularly to rebalance. If you've got a stock that's doing really well, don't let it become too large a portion of your portfolio. And cultivate a large target list and buy the dips. Don't buy breakouts, buy the dips, and that tends to minimise your downside in the short term. Portfolio Analyst this week is really just about building the opportunity base, and I'll continue to do that throughout the year. And that's it for this week. There's my contact details for any non-members. Portfolio Analyst, the $1 2-week trial is still available. There's a lot of very valuable information, I believe, comes out in those sessions, so I would recommend that to you if you haven't tried it. And I'll be back with you next week. Cheers.